Friday night, trade negotiators from the United States and Canada walked away from the table. Within hours, a 50% tariff hit $20 billion of Canadian goods. 2 days later, President Trump threatened to double tariffs on every car, truck, and auto part coming out of Canada. Canada's Prime Minister stood in front of reporters and said, quote, "You are at war when you get attacked. We got attacked. That is not campaign rhetoric. That is the sitting Prime Minister of America's closest neighbor, on the record, this week. So what actually happened? Why did a deal both sides called close on Wednesday completely collapse by Friday night? And the part that actually matters for you, what does this do to prices, to jobs, to the stock market, and to your money if it keeps going?" I went through the White House proclamations, the Supreme Court ruling that already blew up Trump's first tariff plan this year, the actual statements from both governments, and the market data from the last few trading days. Let's break it down. How we got here. This didn't come out of nowhere. Rewind to February 1st, 2025, days after Trump's second term started. He announced his 25% tariffs on most Canadian goods and 10% on Canadian energy, citing fentanyl trafficking and the border. Canada retaliates. Within weeks, Trump carves out an exemption for anything compliant with the United States-Mexico-Canada agreement, the free trade agreement he himself signed in his first term. So roughly 85% of Canada-US trade stays untouched. Steel, aluminum, and autos get hit with their own separate tariffs on top. By August 2025, non-compliant Canadian goods are facing 35% tariffs. Canada's Prime Minister, Mark Carney, a former central banker who took over from Justin Trudeau, actually pulls back most of Canada's retaliatory tariffs that same month, betting that the escalation would bring the US back to the table. It doesn't. Not fully. Both countries spend the rest of 2025 in this pattern: threat, tariff, partial retaliation, partial rollback, repeat. Then in February 2026, something huge happens, and it has nothing to do with Canada directly. The Supreme Court blows it all up. Trump's entire 2025 tariff strategy rested on one law, the International Emergency Economic Powers Act, an emergency powers law from 1977. Trump was the first president in history to use it to impose tariffs. On February 20th, 2026, the Supreme Court ruled 6-3 that the International Emergency Economic Powers Act does not give the president the power to impose tariffs at all. Every fentanyl-related tariff on Canada, Mexico, and China, and every reciprocal tariff on the rest of the world got wiped out. Businesses that paid those tariffs are now owed refunds. Some estimates put that number as high as $175 billion. For about 4 days, Canadian goods were tariff-free again, when Trump pivoted. The same day as the ruling, he announced a new 10% global tariff, this time under Section 122 of the Trade Act of 1974, a law that had never once been used to impose tariffs in its 50-year history. There is a catch. By statute, Section 122 tariffs are capped at 150 days unless Congress extends them. But clock started ticking immediately when it expired in late July 2026. Tariffs didn't lapse. The administration pivoted again, this time using Section 301, forced labor investigations into 60 countries, Canada included, to justify a new 10% tariff. And separately, under yet another law, Section 338 of the Tariff Act of 1930, never once used by any president before. Trump moved to hit specific Canadian sectors: dairy, alcohol, and motor vehicles, over what the White House called discriminatory treatment of American exports. 3 different legal justifications in 6 months. But it's not a small detail. Trade lawyers are already saying Section 338 could face the same kind of court challenge that killed the first round of tariffs. The deal that almost happened. Here is where it gets interesting. Through most of August 2026, negotiators from both countries were in Washington for what officials called intensive line-by-line talks. On Tuesday, Trump even posted that the two countries had a deal. The agreement on the table would have actually cut tariffs, Canadian cars and light trucks from 25% down to 15%, and steel and aluminum from 50% down to 25% when it fell apart fast. According to Carney, the US introduced late-stage demands that went far beyond tariffs. He said Washington wanted to restrict Canada's ability to sign trade deals with other countries, a clear reference to Canada's separate agreement with China. He said American negotiators pushed to change the terms specifically on medium and heavy-duty trucks, which became the sticking point that killed the deal. And he said the US wanted concessions tied to Quebec's language and cultural protection laws. Bill 96, which makes French the official language of Quebec, and Bill 109, which protects Quebec's cultural sovereignty. Carney's framing was blunt. Accepting those terms, he said, would have made Canada the economic equivalent of a 51st state. Trump's response, posted to Truth Social the next morning, Canada wants the benefits of being a state without being one. By midnight Saturday, the deal was dead, and the new tariffs were live. What is actually being taxed right now? Here is the concrete part. As of Saturday, August 22nd, a 50% US tariff hit roughly $20 billion of Canadian exports, about 5.5% of everything Canada sells to America. The list is oddly specific. Dairy products, beer, wine and spirits, cement, hockey equipment and other sporting goods, furniture, building materials like lumber and plywood, clothing, footwear, electronics, toys, and even flowers and seeds. Two details matter more than the list itself. First, unlike almost every previous round, this one applies even to goods that are fully compliant with the United States-Mexico-Canada Agreement. The exemption that had protected 85% of Canada-US trade this whole time doesn't apply here. Second, these tariffs have no expiration date written into them. What is not on the list also tells a story. Oil, natural gas, and potash, three of Canada's biggest exports to the US, are excluded. For now. Canada fires back. Carney didn't wait long. He announced Canada will match the US dollar for dollar, effective September 8th. The target list: American steel, dairy, appliances, agricultural equipment, pulp and paper, and electronics. 2 days later, Trump escalated again, posting that starting January 1st, 2027, tariffs on all Canadian cars, trucks, auto parts, and steel will double to 50%. But threat lands very differently than everything before it. And here is why. Why the auto threat is the one to watch. Everything up to this point, the dairy, the hockey sticks, the cement, is a small slice of total trade. Analysts told multiple outlets this week that the near-term hit to US consumer prices from the August 22nd tariffs will be modest, because the dollar amount is small and the goods list, while long, isn't concentrated in anything Americans buy constantly. Cars are different. The US and Canadian auto industries are built as one integrated system. Parts cross the border multiple times before a finished vehicle rolls off the line. The president of Canada's Automotive Parts Manufacturers Association put it bluntly this week: cut off specific Canadian-made parts, and US auto assembly lines don't slow down, they stop. If the 50% auto tariff actually takes effect on January 1st, economists warn it could raise car prices for American buyers and hit employment in US auto manufacturing, since the industry cannot swap suppliers overnight. That is the scenario worth watching more than anything that's already happened. How Wall Street reacted. In the trading days since stocks collapsed, US markets have been choppy, but not panicked. The Standard & Poor's 500 dipped roughly 0.25% on the day the tariffs took effect, and again on the day Trump threatened the auto tariffs, while the Dow Jones actually ticked up slightly both times. The volatility index, Wall Street's fear gauge, jumped more than 4%, but stayed at historically normal levels. Gold pushed toward 5-month highs above $4,600 an ounce. Oil dropped. US steel stocks, oddly, went up, since Canada naming steel as a retaliation target reads to some investors as good news for domestic steel makers facing less competitive pressure. Worth noting, it is not all about Canada this week. Investors also have the Fed's Jackson Hole Symposium and Nvidia's earnings report competing for attention, so some of the market's calm is really just all the stories crowding out the tariff headlines, not the market shrugging off the trade war entirely. The bigger context, markets have gotten somewhat numb to tariff headlines over the past year and a half. There is actually a nickname for it on Wall Street, the taco trade, spelled TACO, short for Trump always chickens out, because so many 2025 tariff threats got delayed, negotiated down, or reversed. But several analysts flagged this round as different because of the no expiration date detail, because Canada is actually retaliating this time instead of standing down, and because the auto threat, if it is real, is a much bigger deal than anything so far. The case for and against. Let's lay out both sides fairly, because this is genuinely contested among economists, not just among politicians. The case the administration makes: tariff revenue is real money. Customs collections jumped from $79 billion in 2024 to $264 billion in 2025, and the administration's own projections put total tariff revenue at $1.5 trillion over the next decade. The White House points to manufacturing data, a multi-year high reading on the Institute for Supply Management Manufacturing Index in early 2026, and the first quarter of positive manufacturing job growth in 3 years, as proof tariffs are pulling factory jobs back to America. They also argue Canada's own trade practices genuinely disadvantage American exporters and deserve a forceful response. The case critics make. Independent analysis tells a messier story. A study by the consulting firm Kearney found tariffs haven't driven meaningful reshoring. US imports from China fell by about $135 billion last year, but imports from 13 other Asian countries rose by a combined $193 billion. In other words, production moved to Vietnam and India, not Ohio. One analysis found the US has actually shed roughly 75,000 manufacturing jobs since Trump took office, not gained them. On cost, the Nonpartisan Tax Foundation estimated the 2025 tariffs cost the average American household about $1,000 that year, and projects the broader tariff regime will shrink long-run U.S. gross domestic product by 0.4% and cost the economy the equivalent of 345,000 full-time jobs. And there is a legal risk baked into all of this. If Section 338 goes the same way the International Emergency Economic Powers Act did, this whole structure could get struck down again. The two bigger risks nobody is talking about enough. Two things sitting in the background could matter more than anything that's happened so far. First, the United States-Mexico-Canada agreement itself is on the clock. The trade agreement that has protected 85% of Canada-US trade this whole time came up for its mandatory 6-year review on July 1st, 2026. The US declined to commit to renewing it. It hasn't expired. It is still fully in force, but that decision triggers annual reviews from here until 2036. It means the tariff-free foundation underneath of this whole relationship is technically up for renegotiation every single year. Some trade analysts think there is a real chance Trump tries to strike a bilateral deal with Mexico alone and effectively isolate Canada from the agreement altogether. Second, energy is the nuclear option, and it is still on the table. Canada supplies about 4 million barrels of oil per day to the US, more than any other country, much of it feeding Midwest refineries that are literally engineered to run on Canadian crude. Ontario's Premier, Doug Ford, has publicly floated cutting off electricity and critical minerals to the US if things escalate further, and Canada's federal energy minister hasn't ruled out oil export restrictions either. Nobody has pulled that trigger, but if it ever happens, that is the scenario that moves US gas prices, not hockey sticks and cheese. What happens next? Nobody can tell you for certain how this ends, but here is the range of what's actually on the table. Scenario 1. Cooler heads prevail. This has already happened multiple times in this saga. Escalate, then partially walk it back. Talks could resume before September 8th, and some or all of the new tariffs could get negotiated down again. Scenario 2. A grinding prolonged standoff. Canada's retaliation goes ahead September 8th. The auto tariff doubling goes ahead January 1st. Both economies absorb the cost in higher prices and slower growth without either side blinking. One Bloomberg headline this week put it plainly: Canada is bracing for a trade war that could last well past November 2026. Scenario 3. Real escalation. Energy and critical minerals get pulled into the fight. The United States-Mexico-Canada agreement negotiations break down further. Legal challenges tie up the new tariffs in court. Analysts flag this as the lower probability outcome, but the one with the most serious economic consequences for both countries if it happens. For a relationship that has been almost tariff-free for 3 decades, this is uncharted territory. What started as a border security dispute in February 2025 has turned into a fight over sovereignty, language laws, and who gets to set the terms of America's most integrated trading relationship. The next real deadline is September 8th, when Canada's retaliation kicks in. Mark it on your calendar. I will be back with an update the moment something moves.